Hello and welcome. Thanks for tuning in to KYC. I'm Harsh Saita and today we're going to be speaking with Kalpataru Projects. It's a strong set of Q1 numbers. It's a very strong FY26 guidance as well that they are penciling in. But here's what I want to know about Kalpataru Projects. And more so, just trying to understand whether this entire T&D space could well be something that you could bet on in a safe manner and still get a good growth, and which players could you bet on. But you know, Kalpataru Projects in particular, there have been payment delays that the company has witnessed. So I want to understand whether this can change, this can reverse. Are there any specific segments where they are witnessing this? So that's the other piece. And how much of this is caused by government? What are they doing to shift away from government contracts? So that's the first part. Second, as a result of this, working capital needs are inherently higher. Mind you, in general, in engineering, procurement and construction companies, you will have higher working capital requirements because you will have amounts, chunky amounts stuck up in working capital. That is normal, and therefore your return ratios matter far more. So yes, you will have working capital needs which are inherently higher, yes, but will they continue to increase every year? Is that something that you as an investor should pencil in into the cash flow, which will keep a lid with regard to cash flow from operations growing at the same clip as EBITDA will? So that's what I'd want to really understand. The third piece is with regard to water business. Will you see a slowdown with regard to water business? Because this is more government, less private generally. So I want to know if they will ease their focus on the water business at all. They're also doing divestment of non-core, and I'll talk a little bit about that as well. The fourth piece is oil and gas. Now, within the oil and gas space, they're doing a lot of contracts which are export focused and export oriented. That's what they are focusing on. So I'd want to know whether the margins here are better and how large the opportunity is. So if we roll forward, margins in oil and gas versus the blended margin is what I'd want to know. So there are two key factors within Kalpataru Projects that I want to talk about. One is the margin number. The second is the ROC. Can the ROC go up and can the margin number creep up? That's the guidance, and where will that lever come from? So these are the two pieces, and I've just kind of combined the two into one. What stops you from growing at roughly 20-odd%? The order book is quite healthy, nearly 3 times book to bill is what they're currently at, and therefore, given that, you'd want that they can grow at a 20% plus clip for a prolonged period of time. Plus, all of the verticals that they have are strong growing as well. They're well in vogue. Oil and gas is well in vogue. Transmission is well in vogue. So you've got those levers to kind of kickstart and keep growth coming. Debt direction, where do we go in terms of that? And last part is selling of non-core assets. They have some non-core assets on their balance sheet, and in order to improve their ROCs, what they're doing is they're trying to sell some of that. So some of those metrics will start to play out in coming years. How much of that comes onto the balance sheet as cash is what I'd want to also understand. But we'll start off with about the company, and we're missing Anushi today, who generally tracks EPC. But let me do the best I can. Let me start off by explaining what exactly does Kalpataru Projects do. It's a leading global EPC player. EPC full form on your screen. Put it in a nutshell, it executes infrastructure, energy projects in 75 countries. It focuses on power T&D, which is transmission and distribution, buildings, water, oil and gas, railways and urban infra. Again, railways and urban infra is a very interesting high growth tilt to the business. Asset light model is what it focuses on. It scales by managing complex projects and not really owning the asset. So they don't do as much of build, own, operate and the like. So that's not really the model that they follow. They generally follow a model where they receive the money upfront and hand over the asset to the government. That's how they prefer playing this. Let me start off also by explaining what are the types of projects that they take on. So first, within the power T&D space, you'll see the various verticals come on the yellow band on top, and then you'll see a description here In the power T&D space, they build transmission lines, substations, from engineering to installation. They do in-house design, manufacturing, testing of towers as well as equipment. In terms of building and factory, which is their second vertical, they construct residential, industrial, airports, data centers and factories, of course. And outside of that, they offer design, build, and not just construction. So they also offer that part of the service. In terms of water and irrigation, of course, some part of the contracts here are government predominantly. They lay water pipelines, install treatment, storage, they manage supply. They also handle O&M for water systems. So some of these are of course valuable. Oil and gas. Now this is the new possible vertical where there could be strong growth, especially from the export opportunity. So they are installing pipelines, refinery facilities, terminals, compressor stations, all of that. In terms of railways, electrification, track links, signaling, station development, all of that is what they do. That's the broad brief with regard to the services they provide. Let's talk about the order book now. It's at around 65,000 crore, Q1 FY26 of course. It's at an all-time high. Domestic is roughly 59% odd. 41% is international, and here's the order book to bill. That's the more important ratio, and I'm going to talk about that only till FY25. So that's the broad brief with regard to book to bill, nearly 3 times, and has been the case for the last 3 years. So they've consistently maintained that. That's the run rate at which they've been going. Let me talk about order book mix also, because that will give you a tilt with regard to margins, and we'll discuss margins just for a little bit. You look at the power T&D. This is roughly 41% of the current book size of around 65,000 crore. So around 41% is power T&D. That part of the 65,000 crore. So that part is slightly higher and better margin. Building and factory is 22%. That is also better margin. So around 63% of the book is those two. Then you have water, which is 15%. Oil and gas, which is 12%. Oil and gas reportedly has the best margin, but of course that question I'm going to pose with the company. And urban infra and railways is around 10% odd. So that's broadly the mix of the order book. In terms of water, 15% of the book, the margins may compress a bit, and that's likely more so because it's government tilted. So you want to take care of that part. And I want to see as to what the commentary says as well. Let's talk a bit about the business model. And the business model in terms of manufacturing, in-house key component manufacturing of transmission towers, scaffoldings, etc. They have a facility in Raipur and Gandhinagar in India for this. Project execution, well, they have a central project management office in Mumbai. And then they have project teams all over at project sites which manage the project. Last off, there's sales and customers, of course. They sell EPC contracts to governments, PSUs, large private developers and international agencies. They do claim high repeat customers due to track record as well as relationships. So that's the broad brief with regard to a Kalpataru Projects International. Now let me talk about the metrics that we will discuss on a Kalpataru projects. We'll start off with the income statement. We'll thereafter look at the balance sheet, cash flow and return ratios. We'll then look at shareholding patterns, street cred, valuation, street coverage, and they've guided also on a couple of factors. We'll talk about that as well. Let me start off with the income statement. Now you look at the top line and the growth there. It's been around 15% 3-year CAGR. The EBITDA is up by around 13 odd percent. Margins are largely steady state between 8 and 9% over the last 4 financial years. FY22 9, FY23 9, 8 and 8 for FY24 and 25. And therefore you're seeing a bit of compression on the profitability. So we're not seeing profits grow at that 15% clip as the top line. It's just a 2% profit growth on a CAGR basis. So you want to see more on that profitability number. Now let's talk about the Q1 FY26 numbers. And this is really strong coming in from a Kalpataru. The net profit stood at 200 crore for Q1 FY26. I'm going to pull out the top line number as well in just a minute. So your top line has grown 35%, mind you. on a YOY basis. Your EBITDA is also up a very, very solid 39%. So you're seeing strong growth across the board where Kalpataru Projects stands, 38.6%. Your margins have come in at 8.5% versus an 8.3% same time last year. So your margins have inched up, and that has aided profitability in a very, very strong fashion. In fact, this will mean that FY26 will be a standout year, and we'll dive deeper and understand whether that is actually possible or not. But given the last 3-year performance, we've given this a neutral. We want to wait and watch as to what the guidance is with regard to margin uptick and profitability going forward. But very, very likely there could be a bit of turnaround here. But we've been cautious on this one. Let's look at the balance sheet. Equity, roughly a total equity of around 6,500 crore. It's a 20,000 crore market cap company. It's trading at around 3 times book. Your borrowing is around 4,000 crore, but cash bank balance is around 1,800 crore. And I'm sure a large part of that profit as well would have likely come into this cash balance at the end of FY25. You want to keep your eye out on that as well, because that will mean your net debt has come down. And it has. Your net debt to equity has come down to around 0.3 to 0.2 times roughly at the end of FY25. That will likely continue to come down. We'll understand the debt picture better going forward. Let me talk about the cash flow now. So we've given the balance sheet a neutral as well. Want to see more work being done. Even though the net debt to equity has come off, I want also an outlook on the debt. Cash flow. This is where there's been some bit of pain. Your operating cash flow to EBITDA stands at just about 50%. You want this to likely get better, right? And maybe EBITDA is not the right metric because interest cost is also extremely elevated. But even on the overall numbers, you want operating cash flow to improve. The receivables keep a lid and the working capital keeps a lid on operating cash flow. Again, EBITDA, you have interest taxes that you need to discount for when you do CFO to EBITDA, and therefore, and because this is slightly more capex heavy and slightly higher interest cost that it incurs, therefore the CFO to EBITDA number has squeezed. The net cash flow though remains intact, and that is because of the equity raise it has done last year. It also did its IPO a couple of years back, and it also has done a couple of debt raises and debt repayments as well. So you want to know some of those things when you're looking at the net cash flow picture. The return ratios. The return ratios look all right. The ROC number is roughly 16% and as I did mention, there is a possibility for a positive bias to return ratios, but they've been stable. I'll give them that credit. So therefore, the thumbs up. Let's look at shareholding now. Promoters, roughly 33.5% currently. So we've given this a neutral. FIs have increased their stake. FY23 to FY25, they've really increased their stake. DIS 2, the stake has gone up. Public also, the stake has largely been steady state. So that's the broader picture with regard to shareholding. Neutral on this one. Street cred, 1 month stock price action is -6, 6 months is +8, year to date is -15, 1 year is -10. So shareholders haven't exactly made the best returns. The 1 year shareholder is under some bit of pressure. But since 2023, the stock has more than doubled. So over slightly stretched periods of time, of course, we've seen a better performance from Kalpataru than in the near term. So that's the other thing, and therefore we've given this one a neutral as well. Longer term, okay, but shorter term, some bit of pressure coming in on shareholders. Let's talk about valuations now. And Kalpataru Projects currently trades at around 30 times earnings. KEC, which is its competitor, trades at around 38. And Transrail, which is purely T&D, trades at around 30. You've got 1 year forward, those numbers changing dramatically because of the growth tailwind that's there. Broadly, we've given this a neutral. 2 reasons. One, a 21 times high growth business definitely looks good, but you want to see what happens to the debt picture as well. You want to see what happens to the cash flow picture as well, and whether margins can inch up and the return ratios can inch up. So some of those factors need to be kept in mind. Those are a work in progress, and therefore keeping those in mind along with valuations, you want to be cautious. That's why the neutral. In terms of analyst recommendations, there are 15 buy calls, there are 2 hold calls. no sell calls. There is a 19% return potential, which the average Bloomberg analyst expects from this one. 17 analysts track it. So surely not looking bad, a clear thumbs up with regard to this one as well. Let's stack up all of those 8 metrics and give Kalpataru Projects its KYC rating. That's how it stacks up. Cash flow, a bit poor, right? So we've given that a thumbs down. Other than that, everything looks okay. It's all in place and therefore gets a 5 out of 8 on our KYC rating. Now let's go across to management. Let's speak with Mr. Amit Uplenchwar, who's going to be joining us, who's a director at Kalpataru Projects. Welcome, sir. I'm Harsh here. Good speaking with you. Let me start off with working capital. That's the one possible drag on your return ratios. But talk to us about the business itself. Is working capital just a part of the business that you do, and therefore it has to be factored in from an investor lens? Or would you look to optimize it? And are there levers to optimize it? And if so, how much?
So, good morning, Harsh.
Good morning, sir.
Thank you very much for having me on your show.
Thank you.
Very, very interesting question. You know, as you follow the EPC business cyclically, you should look at this lens from a constrained perspective. Has cash flow ever constrained the growth of KPIL? And the answer is no, right? If you look at our metrics, today, if you look at amongst our peer group, we are keeping our net working capital days at less than 100, which is at our scale and size with a diversified order book and sectoral as well as geographical spread. I think it's one of the best in the industry. We've also kept our interest cost as a part of our revenue under 2%, which again amongst the entire industry is one of the lowest, which shows a very, very strong balance sheet and extremely low levels of debt in relation to our business. If you look at our third metrics, which is debt to equity on a standalone basis and on a consol basis, today we are at less than 0.47 of our debt to equity, and on a standalone even lower, which is again one of the lowest in the industry to have a near debt-free status on a standalone basis. And we have, like you correctly mentioned on your show, we've had a 15% CAGR over the last several years. And in this year, in Q1, we've done our highest ever revenue at 35% levels of growth on revenue, both on standalone and consol, with pretty much keeping the debt levels at the same that we've been doing. So we've factored the growth through the similar balance sheet levels of debt. So I would say this is one of the best and the strongest balance sheets in the industry ever. And cash flow has never been a constraint for us, with enough and more headroom to grow in the future.
Point taken, sir. So on your cash flow from operations, what should be the pre-cash flow from operations on your PBT number, what should be the drag of working capital that one should pencil in annually?
So I think, Harsh, let's look at this question in a different light, right? Today, as a company which is having 65,000+ crores of order book in hand, and on a lighter note, in this uncertain world, the only certainty that we've provided over the last several years is a very, very stable financial performance in terms of profitability, right? So we are doing close to, last year we were at 4.5% PBT thereabouts. We've already inched up beyond 5 this year, and we've guided at the beginning of the year to go close to 5.5, which is 100 basis point expansion on our PBT levels. And the kind of revenues that we are doing, I think this is one of the highest amongst the peer group if you do a comparison. At 5.5% close to PBT FY26 closing, I think would be one of the best PBT in the industry at that scale.
No, sir, I completely take your point. I completely take your point on that. Right, sir, let me switch focus. Let me talk about water for a bit. Is there a thought process behind how you will bid for projects within water, keeping in mind what you've just told me, that the PBT margin of around 5.5%, does water fit the bill there? And will you be very, very selective there? And therefore, where does the water mix stand maybe a couple of years from now? Will it come off? Will it stay steady state?
So, Harsh, again, a very interesting question. I think you've analyzed our company. You probably know the numbers better than I do in the way you ask the questions. But in terms of water, we've got 9,000 crores thereabouts of order book that we have on hand. Right? Water is a beyond 5.5 PBT business simply because it has very, very low capex. Right? And right now, we've had a 1.5 year of a bit of a slowdown because of protracted elections last year and stuff, because of which the collections have been slow in the water business. But if you see the last 5 years, it has been a stellar business in terms of growth. I think water has, in my doubt, every year when you see the budgetary allocations from the central government towards water, it's a very, very high number. And we are very confident that whilst we will collect our monies that are owed to us and progressively that has started happening, we will see more growth coming in the water next year onwards. We are cautious this year. However, a huge tailwind for us in our water business is our ability to bid for water projects outside of India, where there continues to be a very large opportunity, be it the Middle East, whether it's desalination, whether it's STPs, and the higher value add water kind of projects, which our focus is going forward.
Got it. Where do you've guided for a 20% top line growth, Amit, and you're guiding for margins to likely get better. And it's already gotten better in Q1 FY26. It's a very impressive performance where Q1 is concerned. I'm trying to understand full year. Is this kind of steady state number in terms of execution doable?
So, Harsh, I think this has been one of the best Q1s that we've had ever in the history of the company from an absolute number perspective, both on standalone and console. We've had a very high growth of 35% this year. To answer your question, we had guided at around 20% at the end of FY26 as revenue growth for us. And I think I can say that by the end of year, our target is to increase that guidance and go to 25% thereabouts, both on standalone and console. And I think looking at the growth momentum that we have and the orders in hand, I think that's what we should be aiming at. And I think at the cost of increasing our guidance, I think our target is to get to 25% revenue growth, both on standalone and console at the end of the year.
Wow. So you've upped your guidance here from 20 to 25%. Amit, what should therefore the FY27 be like? Will that be a bit of a drag given that there'll be a stellar FY26, or can you continue to grow at 20% on that higher clip?
So I think that is our objective. It will be premature for me to say we are still in Q1 on FY26. There are too many events that are happening around the world that are outside our control. However, FY26 seems loaded and locked in terms of the numbers that I just mentioned, because it's in front of us. However, given the order book that we continue to have, we've already done around 33% of our order inflow guidance at the end of Q1, close to 10,000 crores. And I think we should maintain 20% guidance also, but we will talk about that towards end of Q3 and beginning of Q4, as it's kind of early to give numbers for FY27.
No, excellent. Thank you, Amit. No, we appreciate the cautiousness on the guidance. Amit, on margins, you have suggested a couple of times on con calls earlier that there is a positive bias to margins. As you tilt the product mix to higher margin, as you optimize operations, as you scale, talk to us about where should we expect the margin number, if not for FY26, maybe not the immediate term, but if you can give us that guidance. And if not, then maybe FY27, 28. Where's the direction and how much can you increase it by?
So, Harsh, given that we have uncertainties in business, sometimes some divisions would slow down because of factors beyond our control. We've been steadily saying that our objective and intent is to increase our PBT steadily and ensure that we maintain that and sustain that. If you see in the last 24 months, we've had almost 150 basis point PBT increase to our contribution in terms of our percentage of profits. And I think our objective, even when we started at the beginning of the year, we said we should be, between 5 and 5.5%. And I think we are trying very hard with everything in place to try and be at the higher band of that PBT margin. And our objective is hopefully to maintain that and, try and make an effort to go ahead of those numbers in the following years.
5.5 likely upside in terms of FY26, and thereafter you'll build on top of that. But that's extremely strong guidance, because what you've done maybe in FY25 is roughly 4% or maybe thereabouts. And therefore, it's a very, very strong guidance that you're giving. Thank you so much, Amit. This is insightful. Thank you so much for coming in and chatting with us.
Thank you, Harsh, for having me. And yeah.
Yeah. Okay. That's, of course, the management of Kalpataru Projects for you. 5.5% PBT, and they're looking at a near 25% growth. Hopefully, they are able to execute on that. The earlier guidance was 20%. You want to probably look at those numbers afresh as you try and make a decision on how to look at this one. But viewers, thank you so much for watching KYC. From all of us here, it's a goodbye.